Hi guys, in this video we will look at the two popular investing options. One is investing in stocks through index funds and the second one is investing in real estate. Investing is the way to grow your wealth over time rather than keeping it in savings account in a bank. This is essential for retirement, for achieving financial freedom. If you are new here, my name is Parul and I'm an economist by profession, and I make videos on money management and getting financial freedom fast. So let's get started. We will start with index fund investing. So put it simply, index fund investing is when you are investing in a bunch of companies through a mutual fund, which basically passively tracks an index. So the index could be anything, which could be S&P 500 index or the total US stock market index. So the index fund tracking the S&P 500 index would track the 500 largest US companies by market cap, and you can get it into this investing through any of the leading brokerages like Vanguard, Schwab or Fidelity, or through your 401k plans. In fact, it is a very popular retirement strategy for investment. The idea is that you don't invest in one or few companies, but in a broad set of companies. Index fund investing is a passive form of investing where you kind of put your money, every month it is taken out from your bank account and is invested. So it is something like set it and forget it. The other advantage of index fund investing is the expense ratio, and it's usually very low. For example, S&P 500 index fund through Vanguard only has an expense ratio of 0.04%, which means that if you invest $10,000 yearly, you only pay $4 per fees, which is nothing. As I said, index funds are collections of stocks that mirror a market index like S&P 500. They are easy to invest in, diversified, and have low ratios, so they're great for long-term growth and are less volatile than individual stocks. If we look at the performance historically, index funds have grown steadily. And as I said, it is a very popular investment vehicle for retirement purposes. And the only problem I would say is that it could be boring for some people because there's not much you can do other than just, getting the money taken out from your bank account and, letting it grow over time. So it doesn't have that, active involvement, if some people prefer that. You also don't have any control on the type of stocks you can invest in because you're basically mimicking an index, and sometimes external factors can affect your return in certain months if the overall market is experiencing a slowdown. Usually the market would bounce back, so if you have invested in a broad-based index fund which is tracking something like S&P 500, you should not worry. But again, some type of geopolitical conflicts, economic uncertainty, it can affect the overall returns during some short duration. Risk-wise, it comes in the low to moderate risk category due to diversification. Now let's look at the real estate, which basically means you're buying a property for renting and for appreciation of the value over time. So if you're renting, you get a rent each month that typically can cover your mortgage payment for that property. So, and once the mortgage is paid off, then you get all the passive income through rent, as well as later when your investment has gone up through property appreciation, it can overall increase your total return on investment. Now this is not a passive option because there is more active involvement in terms of managing the property, especially when you're renting it to someone. The biggest pro of real estate investing is the potential for appreciation. So house prices have historically increased around 4 to 8% annually, and there have been some exceptionally good periods. And of course, the rent that you're getting is added, passive income. And as I said, it can take care of your mortgage, sometimes the repair cost of the house, and it is a tangible asset. That means you can physically touch and see your property, unlike stocks. Also, you can use leverage, which means you can take a loan from bank and you don't have to have all the money to buy a property. If you have 20% down, you can still use a bank loan and get a property, which hopefully in future will increase in its value. The biggest con is that once you have a property, it is not very easy to manage it, and you cannot sell it if you require the cash very soon. We don't know how long it takes to sell something. So this is usually done for long-term investing anyway. But selling an index fund is relatively quick. You can sell it and get the money very soon in your account. As I mentioned, real estate will have maintenance costs, so you have to be very actively managed. Sometimes you have to hire a manager if you don't live in that city, so that would mean that you will pay fees to that manager for maintaining your property, taking care of the renters. So this will eat into the returns that you can get otherwise. And of course, market fluctuations can overall impact the housing market. Risk-wise, I would say it comes in a moderate to high risk due to market fluctuations and property management issues. Now, let's look at REITs, which is the Real Estate Investment Trust. They allow you to invest in real estate without owning physical property. REITs provide regular income through dividends and the potential for capital appreciation. Some of the pros are lower initial investment than direct real estate, diversification, and liquidity since they are traded on stock exchanges. Of course, there's a problem that returns can be affected by interest rates and economic conditions. Risk-wise, they are in the moderate risk category, affected by the real estate market and broader economic factors. If we look at the historical returns, then stocks have outperformed real estate returns over the period of history. The S&P 500 has an average annual return of 10% for over long periods of time, whereas we have seen 4 to 8% annual average returns in case of real estate. There was this study conducted by Damodar, who is a professor in NYU, and he has compiled this table where he is looking at different assets and their returns each year, and what is the value of $100 invested in 1928 in each of these years until 2023. So you can see how they are fluctuating, and by this table we can see that stocks, which means S&P 500 index overall, has outperformed any other asset class here. And stocks have been more volatile with more peaks and valleys, but just comparing the return is not the complete picture, because you also look at your investment horizon, how active or passively you want to manage your investment, and other factors like market conditions can affect your return. Okay, let's look at the tax implication of index funds first. Index funds are generally tax efficient as they have lower turnover rates, which means there is no active manager buying and selling different stocks for you. It's pretty much passively tracking an index. So whatever the S&P 500 index comprises of, the largest 500 companies, that's what the index fund is tracking. So it doesn't have a high turnover ratio. So overall, they will have fewer taxable events compared to actively managed funds. Dividends received from index funds are typically subject to tax. Qualified dividends are taxed at the lower long-term capital gains rate, while non-qualified dividends are taxed as ordinary income. Investors are liable for capital gains tax on the sale of shares. Long-term gains that are held for more than 1 year are taxed at a lower rate compared to short-term gains. Let's look at REITs. They are usually taxed as ordinary income because REITs are required to distribute at least 90% of the total taxable income to shareholders. These dividends do not benefit from the lower tax rates applicable to qualified dividends. Similar to stocks, when you sell REITs shares, any profit is subject to capital gains tax. Long-term capital gains are again taxed at lower rate. Some REITs may offer dividend reinvestment plans, which can allow investors to invest in dividends in additional shares, which can potentially defer taxes. When it comes to direct real estate, investors can deduct expenses related to property management, the maintenance and mortgage interest and other property taxes, as well as sometimes if there's a depreciation, you can reduce your overall taxable income. When you sell a property, you may be subject to capital gains. Long-term capital gains, which are held for more than 1 year, are taxed at a lower rate than short-term gains. There's also something called 1031 exchange, which allows deferring capital gains tax by reinvesting the proceeds from a sold property into a similar property, which many wealthy people do. So yes, real estate offers more tax benefits like deductions and depreciation, but involves more complexity. Index funds are generally tax efficient and simpler in terms of tax implication, and REITs provide regular income, but dividends are taxed as ordinary income. Choose based on your tax situation, your investment goals, and preference for simplicity and complexity in managing taxes. So which is the right one for you? For beginner investors, I feel the best choice is index fund investing because they are simple and they provide steady growth. There is not much for you to do other than just opening an account with a brokerage and then just letting monthly amount taken away from your bank account, and it's automatically invested in that index fund. And since they're passively managed, they usually have low fees. You also don't need a lot of money to start investing in index funds. REITs are a good second option if you're interested in real estate but want to avoid the hassle of property management. And direct real estate investment is best for those who are willing to put in that time and effort and have high risk tolerance. I think the combination of both REITs and index fund investing is good for most people. Until you have enough funds to put 20% down for real estate investment, then you can add that in addition to these two. Of course, that will be more active investment, but always start with index fund investing, and this is great for retirement purposes. If you like today's video, please give it a thumbs up and let me know in the comments if you have any questions about this video. Thank you so much for watching, and I will see you in my next one. Take care. Bye.